Imagine this scenario. Someone walks into a meeting with the owner of a multi-million-dollar company, having no money in their bank account. 90 days later, they own the business. No traditional bank loan, no outside investors, no money down. This isn't fantasy. This type of deal has been completed thousands of times by entrepreneurs who discovered something the wealthy have known for decades. You don't always need money. To buy a business, you need something far more valuable. But here's what nobody tells you. This strategy, this financial maneuver that's created substantial wealth over the last 40 years comes with a dark side. A hidden risk that's destroyed businesses, bankrupted families, and left sellers with nothing but regret. So the question isn't whether you can buy a business with no money. The question is whether you should. To understand how this works, we need to go back to the 1980s, when the entire landscape of American business was being rewritten by a financial innovation that would change everything. Before the 1980s, if you wanted to buy a business, the process was straightforward and brutal. You needed cash, lots of it, typically 50 to 80% of the purchase price upfront. Banks would finance the rest, but only if you had substantial collateral and a proven track record. The game was simple. Wealthy people bought businesses from other wealthy people. But then something shifted. A new structure emerged from the world of private equity and investment banking. Pioneered by firms like Kohlberg Kravis Roberts, they called it the leveraged buyout, or LBO. The concept was revolutionary. Used the business itself as collateral to finance its own purchase. Think about that for a moment. It is like convincing a bank to let you buy a house by using that same house as the down payment. It sounds impossible, but it worked. The structure looked like this. An acquirer would approach a business owner, negotiate a purchase price, then structure the deal so that the business's own assets cash flow and future earnings would be used to pay the seller over time. The seller essentially financed the sale themselves through what is called seller financing or an earnout. By the late 1980s, this wasn't just for Wall Street titans anymore. Small business owners, corporate executives, and ambitious entrepreneurs discovered they could use these same techniques. The democratization of business acquisition had begun, but there was a catch, a significant one, and understanding this catch is the difference between building generational wealth and losing everything. The mechanics of buying a business with no money rest on three fundamental pillars, and each one carries its own risk profile. Pillar 1, seller financing. This is where the seller becomes your bank. Instead of receiving the full purchase price at closing, the seller agrees to receive payments over time, typically 3 to 10 years. The business itself continues operating, and its profits are used to pay the seller while you, the new owner, take home whatever's left. Here's why sellers agree to this. They often have no choice. The market for small to medium-sized businesses is illiquid. Finding a qualified buyer with millions in cash is nearly impossible. So sellers face a dilemma: sell using creative financing or don't sell at all. Industry data from business brokers and transaction intermediaries suggests that the vast majority of small business sales involve some form of seller financing, with down payments often ranging from 10 to 30% of the purchase price. By the 1990s, deals with minimal down payments were becoming increasingly common. Pillar 2, asset-based lending. The second pillar involves using the business's existing assets as collateral. Inventory, equipment, real estate, accounts receivable, all of these can be pledged to secure financing from banks or specialized lenders. The innovation here was realizing that you don't need to own something to leverage it. You can negotiate to take ownership contingent on securing financing, then use the conditional ownership to get the financing itself. It's circular, but legal. Pillar 3, earnouts and performance. Payments. An earnout structure means the final purchase price isn't determined at closing. It is determined by how the business performs after you take over. Let's say a business is valued at $3 million. You might structure the deal like this: $500,000 at closing, which you secure through asset-based lending. $1.5 million paid over 5 years from profits, seller financing. and $1 million in earn-out payments if the business hits certain revenue or profit targets. The seller gets their full asking price, but only if you succeed. You get to acquire the business with minimal upfront capital. It's a bet on future performance. Between 1995 and 2007, the strategy exploded in popularity. Books like Buying a Business with Little or No Money Down became bestsellers. Seminars promised ordinary people they could become business owners within 90 days, and many did. *** note, the following is a representative composite based on multiple documented acquisitions, not a single individual ***. Consider this type of scenario that played out repeatedly during this era. A former corporate professional acquires a service-based company worth over $2 million, with less than $20. Zero out of pocket. The deal structure: 10% down borrowed from a home equity line, 60% seller financing over 7 years, and 30% in earnouts tied to revenue growth. In successful cases, within 3 years the buyer had paid off the seller, hit the earnout targets, and was generating substantial annual income. By the time the financial crisis hit, they owned the business free and clear and were acquiring competitors using the same strategy. Stories like this became common. The formula seemed foolproof. Find a motivated seller, structure creative financing, operate the business competently, and wealth would follow. The SBA got involved, creating loan programs specifically designed to facilitate business acquisitions with minimal down payments. By 2006, SBA 7A loans were funding thousands of acquisitions annually, many with just 10% down from the buyer. Private equity firms noticed too. They began using increasingly aggressive leverage ratios, borrowing 7, 8, even 10 times a company's annual earnings to fund acquisitions. If the big players were doing it, surely it was safe for everyone else. But beneath this golden age, fractures were forming. The same leverage that created wealth was creating vulnerability. And when the pressure came, those fractures would become chasms. The 2008 financial crisis revealed the fundamental flaw in no money down acquisitions. They only work when cash flow remains stable or grows. When revenue declines, even slightly, the entire structure collapses. Business brokers and transaction attorneys report that during the financial crisis, many highly leveraged acquisitions faced severe challenges. While exact figures vary, industry sources suggest that a significant portion of businesses acquired with heavy leverage and seller financing experienced payment defaults or restructuring between 2008 and 2010. Consider what happens in a typical highly leveraged deal when revenue drops. You've bought a business generating $500,000 in annual profit. You structured it with $100, zero in annual seller payments, $75,000 in asset-based lending payments, and $50,000 in earnout obligations. That's $225,000 in total annual obligations, leaving you $275,000 in profit. Now revenue drops 25%. Profit falls to $375,000. Suddenly, after paying your obligations, you're down to $150,000. That's a 46% reduction in your take-home for a 25% revenue decline. The leverage works both ways. Sellers who thought they'd secured their retirement found themselves taking back failed businesses, worth far less than when they sold them. Banks tightened lending standards dramatically. Sellers became wary of financing deals. The entire market for business acquisitions contracted significantly within 18 months. But the deeper issue wasn't the financial crisis itself. It was that buyers had forgotten a fundamental principle: leverage is borrowed time. Every no money down deal is a bet that future cash flows will exceed your obligations. When acquirers started buying businesses they didn't fully understand in industries they'd never worked in, that bet became increasingly risky. The true cost of failed leveraged acquisitions goes far beyond financial losses. Business acquisition professionals and financial advisors who work with distressed buyers report troubling patterns. Among highly leveraged acquisitions, a substantial portion of acquirers experience significant financial stress within the first few years. Payment defaults on seller notes and other obligations are not uncommon. Sellers who provide financing often receive less than the originally agreed purchase price. The psychological burden on buyers can be severe, affecting personal relationships and mental health. One acquirer, speaking confidentially to industry publications, described the experience: "I bought a business with minimal down payment. That was generating healthy profits. I thought I'd found the perfect opportunity. Within 6 months, I realized I'd bought myself the most expensive job in history. Every dollar that came in was already committed multiple times over. I couldn't invest in growth, couldn't take a vacation, couldn't sleep. I was an indentured servant to my own deal." This is the hidden darkness of no money down acquisitions. You don't buy freedom, you buy obligation. The weight of that obligation, the constant pressure of debt service, the inability to weather downturns, the stress of knowing one bad quarter could cost you everything, destroys more than just balance sheets. It destroys quality of life. After 2008, the industry attempted reforms. Lenders implemented stricter due diligence requirements. Seller financing became more conservative, with larger down payments and shorter payment terms. But these fixes missed the core issue. The problem isn't the structure. It's the education and expectations of the buyers. The SBA increased its scrutiny of acquisition loans, requiring more detailed business plans and industry experience verification. Default rates improved marginally, but the fundamental dynamic remained unchanged. Why? Because the incentives are misaligned. Brokers and intermediaries get paid when deals close, not when they succeed long-term. So they're incentivized to push transactions through, even questionable ones. Sellers want the highest price possible and will agree to risky structures. If it means getting that price, buyers are driven by the dream of ownership and often underestimate the operational challenges. The result is a market where sophisticated, well-capitalized buyers succeed consistently, while undercapitalized, inexperienced buyers continue to struggle, fail, and disappear only to be replaced by a new generation making the same mistakes. Today, in 2025, we're seeing an eerie repetition of the same cycle. The pandemic created a new wave of business acquisition opportunities. Baby boomer business owners are aging out, creating what economists call the silver tsunami. An estimated 12 million small businesses will change hands in the next decade. According to industry projections, online business brokers have made it easier than ever to find acquisition targets. Financing has loosened again. SBA 7A loans are once more readily available with lower down payments. Seller financing is back in fashion. The pitch sounds familiar. Buy a business with minimal capital. Use its cash flow to pay the seller. Build wealth without risking your own money. And it works for the right buyers in the right situations. But industry data suggests troubling patterns. Analysis of business acquisitions indicates that buyers who purchase businesses outside their area of expertise with minimal down payments face significantly higher failure rates compared to those with industry experience and larger capital investments. The difference isn't the financing structure. It's the combination of leverage and inexperience that's toxic. Meanwhile, private equity firms continue using these exact strategies to acquire businesses with massive leverage. Why do they succeed while individual buyers struggle? 3 reasons: expertise, resources, and diversification. Pay firms have teams of operators who can step in when problems arise. They have capital reserves for emergencies, and they own portfolios of businesses. So one failure doesn't destroy them. Individual buyers have none of these advantages. They're all in on one business, often in an industry they barely understand, with zero margin for error. Asterisk the takeaways. 3. Truths about buying businesses with no money. So what does all of this mean for you? 3 critical insights. Takeaway 1. No money down deals transfer risk. Not capital. When you buy a business with no money down, you're not avoiding payment, you're converting upfront capital risk into operational and cash flow risk. The seller is betting you can operate the business successfully. If you can't, You lose the business, damage your credit, and potentially face legal action. The seller loses their expected payments and gets back a devalued asset. This isn't inherently bad, but you must understand what you're signing up for. A no money down deal means every month of operation is an exam you must pass. There's no room for learning curves or mistakes. Asterisk asterisk takeaway 2. Leverage amplifies everything success and failure asterisk asterisk. The same leverage that can turn a modest investment into a valuable business can turn a minor operational problem into bankruptcy. Before you pursue this strategy, ask yourself, can I handle a 30% revenue decline without defaulting? Do I have 6 months of payment obligations in reserve? Am I comfortable with the psychological stress of owing substantial amounts, backed only by a business I am still learning to operate? If the answer to any of these questions is no, either increase your down payment or choose a less leveraged structure. Asterisk asterisk takeaway 3. Expertise is more valuable than capital asterisk asterisk. The most successful acquirers using creative financing share one trait. They buy businesses in industries they know intimately. They're not buying a business to learn an industry. They're buying a business because they already know how to operate it better than the current owner. If you're considering acquiring a business with minimal capital, the single most important factor in your success isn't the deal structure. It is your ability to operate that specific business at a high level from day one. This cannot be overstated. Industry expertise is the difference between success and catastrophic failure in leveraged acquisitions. So, here's what we're left with. Buying a business with no money is absolutely possible. It's been done thousands of times successfully. The strategies are legal, proven, and available to almost anyone. But possibility isn't the same as probability. The uncomfortable truth is that most people who attempt this fail not because the strategy is flawed, but because they underestimate what success requires. They see the opportunity, but not the obligation. They understand the upside, but not the downside. Rick Rickardson, an expert who went on to lead over 50 business acquisitions and co-founded Pine Creek Partners, built his success on deep industry knowledge and operational expertise. The successful acquirers aren't those who find clever financing, they're those who can operate businesses exceptionally well. The question you need to answer isn't, can I buy a business with no money? It's, should I buy this business with no money, given my skills, experience, and risk tolerance? If you've watched this far, you're serious about business acquisition. That's commendable. But I want you to be successful, not just transactional. So, here's my challenge. Before you make an offer on any business using creative financing, spend 3 months studying that industry. Read trade publications, interview operators, understand the profit drivers and the failure modes. If after 3 months you're more excited than when you started, then consider making a move. And if you found this breakdown valuable, subscribe to Finance Expose and Reveal. We cut through the hype to show you how wealth is really built and how it's really lost. Hit that subscribe button, because next week we're exposing the truth behind another wealth-building strategy that everyone talks about but few people actually understand. The path to business ownership is open. Just make sure you walk it with your eyes wide open.